All right, I wanted to make a video here showing what I hold for growth ETFs. This chart here kind of shows my different buckets a little bit. 65% here is in my growth bucket, and then I have my income bucket at 30%, and then 5% is my cash bucket. If you are retired or moving toward retirement, you've probably heard of buckets. And I kind of have buckets within buckets a little bit, if that makes sense. My income bucket, I'll have some covered call ETFs, some regular ETFs, and then also have some cash that I do some option trading on. So it's a hodgepodge of buckets inside a bucket. I don't know if you're allowed to do that or not. It's my retirement, I'll do what I want. But my growth ETFs is what I want to talk about here today. And they are, getting right to it, SPY, QQQ, VTI, and SPMO. And the total is like 65%, and more of a breakdown of each one. So about 29 or 30% of my total portfolio is in SPY, and almost 20% is in QQQ, and then about 5% is in VTI, and then 12% is in SPMO. So let's jump over to Blossom here. Blossom is a social networking type app for personal finance. You can kind of share your portfolio and see what other people are investing in. So it gives you ideas. And just because they're ideas doesn't mean they're good ideas or bad ideas. It's just nice to see what other people are doing and what the consensus is of others. So you can see right here the percentages of what I just talked about. You can see my largest holding here is QQQ at 19%. Now, Blossom can be a couple of days behind lagging. So I actually got about 30% in SPY. So this is a little bit off. I had taken money out and put it in cash, and now I have put it back into SPY. So this should be like 30%. But SPMO, 11.4% or about 12%, that's correct. And then QQQI is a index fund, so I'm not counting that. For this video, I made a different video with my income ETFs, but then VTI is at 4.9% or about 5%. And if I scroll down here, I want to talk about another one real quick, which is basically the same as QQQ. And the biggest difference is the expense ratio is cheaper for QQQM. Now, some people will ask me, why do I use QQQ and SPY when I can use QQQM with a lower expense ratio? And then instead of SPY, why don't I use VOO, VOO? Because it's got cheaper expenses. Well, the main reason and the only reason is because I often write cover call options on QQQ and SPY. I won't get into that right now, but that's basically the reason why I use QQQ and SPY is because of the option trading. So let's take a quick look at each one of these. There's only four we're going to look at: QQQ, SPY, SPMO, and VTI. And actually, when I'm talking about SPY, you could throw in like VOO or some other index funds that try to mirror the S&P 500, and that's what SPY does. So let's click over here and look at SPY. So SPY, State Street, S&P 500 ETF, and it shows how much money is under management. And you can see the current price as of today. And if you scroll down here, it talks about the benchmark. Well, the benchmark is the S&P 500 index. Everybody tries to beat the S&P 500. When people say, I did better than the index, or I beat the stock market last year with my investments, they're probably talking about the S&P 500. And a long time ago, maybe 25 years ago or longer, when I was in my 401ks, I always try to find an index fund in my 401k that mirrored the S&P 500, because I found that most times the S&P 500 fund in those choices often beat whatever else was in those 401ks. Now, this is not advice, but a lot of 401ks, they offer what's called like dated index fund. It'll say like index 2040 or something like that. And what it's kind of doing is trying to time when you're going to retire, and it tries to rebalance automatically based on your age, and then it tries to put some in bonds, some in stocks, and tries to do things for you. I personally don't like those. They underperform, in my opinion. And if I was giving advice to my own kids who are in their 20s and 30s, I'd say don't do that. Just do the S&P 500 index funds. And that's actually what my kids are doing. And their 401ks are doing quite well. So that is what I would do, and that's what I did. And I'll mention real quick that I'm now retired, which is going to bring up another comment here that I'm going to get to in a few minutes. But I want to cover these funds real quick. So you can see the expense ratio, which is really cheap, 0.09%. And I won't go into all the nitty gritty of this, but if we keep scrolling down here, we should be able to see how the return has been for the past 12 months or so. So you can see the 1 year results, about 15% just about, and it shows the benchmark, which is the S&P 500. So because of expenses and some different things, it's lagging behind the S&P 500 just a little bit. But you can see the 3 year, 5 year, and 10 year. And you can see the 10 year average, which is about 11%. So everything that you would expect an index 500 fund to be is what this is. Now let's look at the next fund, which is the Invesco QQQ. So this is actually my favorite fund, even though I don't have more money in this one than the S&P 500 because this is pretty tech heavy. This is like top 100 companies of the NASDAQ. And if you look here, it says top 1% rated, number 3 out of 393 of large cap ETFs, second most traded, 5-star rating from Morningstar, and it's been around for 25 years. And if you scroll down a little bit, you see the top holdings. Obviously, these are all major tech companies. Some people look at Tesla and say Tesla's a car company, but I actually consider Tesla more of a tech company than a car company. We'll click on the 1 year results. You can see it's up 22% for 1 year. So it's just about the end of 2025 when I'm making this video. We just looked at the S&P 500, which was up about 14 or 15% for 1 year. So doing a little better than the S&P, which I would expect it to. And for QQQ, I've been investing at QQQ probably for at least 10 years. QQQ is often 99% of the time not available for people's 401ks usually. And so I wasn't really able to invest a lot into QQQ until I had switched jobs and I was able to roll my 401k over to an IRA, which I did to Fidelity, which is another piece of advice I would give my own kids. If you're ever leaving your job, do not roll your 401k over to the new company. Instead, roll it over into an IRA, and then you can pick your own brokerage like Fidelity or whatever, and then you can have thousands of choices instead of the dozen or whatever that the new company would have for the 401k. Then you can pick QQQ or whatever else you want to pick, and then just start your new 401k off fresh, and then pick probably like an S&P 500 index fund if it's available. That's my advice to my own kids, not to the general public. So do your own research. This is not tax advice, investment advice, or any other type of advice. I'm just sharing what I'm doing with my money. So the next one we'll look at is SPMO. So SPMO is a little different. And what it is, it's the Invesco, which is same as QQQ, S&P 500 Momentum ETF. So what it's trying to do here, if you can read this, it is trying to move the money around into the stocks that are in the S&P 500 that has the best momentum of going up. Twice a year, Friday, March, and September, they look at it and they rebalance things and pick new stocks if they need to, or try to find the ones that have the most momentum. And you can read more about this. I'm not going to go through everything, but if you look at some of the companies, well, one for performance, let's see if it has the year to date. So 1 year is 25%, and the QQQ was like 22%. And you can see the S&P 500 down here is at 15%. So a bit better than the S&P 500. And these are S&P 500 stocks. It's just that, like I said, they're picking the ones with the momentum of going up. And whatever they're doing a good job at it because it's obviously outperforming the S&P 500, and it typically does. So if you want to look at the companies, here are the companies, and there's some of the same ones that you see all over. The thing that's different about this than QQQ is that it's not just tech companies. You see down here, you got Walmart, you got Visa, and JP Morgan. So you can look that up and do a little research on that. So for me, it's one of my favorites, and I have a chunk of my money in there. And the last growth fund that I have some money in, any substantial amount of money that is VTI. So if somebody says, I don't know what to pick, I just want to kind of just match the stock market overall. So not just the S&P 500, but like the entire stock market. So if you just want to try to match the entire stock market, this is what you want right here. So 5% of all of our money is in VTI. So the Vanguard Total Stock Market ETF. And if we scroll down here a little bit, first thing you see performance. So 1 year return, 18%. S&P 500 is 15%. And we looked at QQQ and SPMO already, so they're all doing quite well. And let's jump to the portfolio composition here. And let's scroll down here a little bit. What's different than, let's say, the QQQ is that this is the total stock market. So still 38% is in technology, but you can see, healthcare, financial, energy, all these other things are in here because it's balanced out a little bit different. So if you look at the holdings, you see that Apple, Nvidia, Microsoft, Amazon. So they call these the Magnificent Seven. So the Magnificent Seven is Apple, Nvidia, Microsoft, Amazon, Google, and Meta, which is Facebook. So these make up 7 of the top 10 funds they're invested in. But if I scroll down a little bit more, you see that this is one of 10 of 3,490 pages. So if you wanted to, see what some of these other are like way down here at the bottom, you can click and see some. And obviously some of these you probably never heard of before. Some of these I've never heard of before. But the thing about it is if you want to invest in the entire stock market and have exposure to everything, this is where you can go. And the last thing I want to look at is right here. Let me scroll up to the top here. This is totalrealreturns.com. And you can plug in some tickers from your favorite stocks in here and then compare them. So I went ahead and put SPY, QQQ, SPMO, and VTI. Those are my 4. Now, if you rather have VOO and QQQM, you can plug those in, but you're going to get approximately the exact same numbers over here. So the 1-year return for each of these, they're a little bit off from what we were looking at previously because these are maybe a day or two different, but you can see the S&P 500 about 15%, QQQ almost 19, SPMO 24, and VTI says about 15% here. The other one said 18%, so I don't know what the difference is. And you can scroll down and see a chart. QQQ is actually the blue doing better, but we scroll down here even more. What I like to do is come down here and compare each year. So 2025 here is the year right now. You can see how each of them are doing and compare them to each other. You can see that SPMO is outperforming everybody this year. And then a year ago, SPMO outperformed everybody in 2024. 2023, QQ outperformed everybody. That's when the tech industry come flying back from 2022. 2022, they all had a big drawdown, but QQQ had a bigger drawdown than SPMO. So even though things were down, SPMO was able to reallocate funds and rebalance to find the funds that were going in a positive direction, if any. So they were able to beat the S&P. But then in 2021, it didn't perform as well as the S&P. So you can kind of compare and you can decide if SPMO is for you or not. And for me, I think it's worth being part of. It seems the past couple of years, they've kind of got some things going on that kind of got it figured out. So that's why I put about 10 or 12% of my money into SPMO. And some people ask me, aren't you overly tech heavy? Well, I do have a good percent in QQQ, but we also have quite a bit of money in the S&P 500 and also VTI. So I feel pretty confident that we're balanced out pretty good. If we jump back here one more time, you can see about 30% in SPY, about 20 in QQQ, 5% in VTI, about 12% in SPMO. So I wanted to go back and talk about one more thing before I go. So I'm retired, and people will comment on this, say, well, you should not have all your money in growth funds. You should have it in bonds or something else. Well, I personally don't have anything in bonds that I know of, unless one of the indexes has some money in some bonds or something. But bonds are, I see no use for it. My cash bucket is actually earning like 3.5% better than a lot of the bond funds that are out there. So my cash bucket is basically about a year's worth of money or so that I can draw out of. So I don't have to worry about the stock market going up and down by the week or by the month or even by the year. I have enough cash to live on for actually probably more than a year. So if the stock market takes a dip down, I can wait for it to recover before I have to draw any money out. Plus, the income bucket is generating cash on a weekly and monthly basis from the cover call ETFs, the other types of ETFs, and also the options that I'm doing. And from the option income, I'm actually drawing enough right now where that is supplementing my retirement, where I don't actually have to use none of my money from my income funds that I have. Which brings me to another thing. My ratio was about almost 50-50 between growth and the income bucket and cash. So I did have about 50% in the income and cash bucket combined, and I wasn't using that money. I was drawing more money out into a monthly income than what I needed. So we started shifting money back into growth funds. And then getting back to what I was saying, a lot of people will say like, you're retired, you shouldn't have that much money in growth. And to be honest, at this point, I don't think I'll ever touch that 65%. It'd probably grow. And the way I'm looking at it at this point is I'm probably not investing for me. I'm probably investing for my kids or grandkids or charity, whatever I do with that money when I'm gone. So I guess in other words, if I was 30 years old, those are the things I'd be investing in. So I'll just answer that question because I know I'll get that question. People are watching this saying, "Hey, aren't you retired? You're gonna lose all your money. Have you heard of sequence of returns?" And the stock market goes down, then you draw money out, and then you're gonna go broke when you're 70. Well, I don't think so. I think I'm good. If you are concerned about that, I appreciate your concerns. With that, I'm gonna wrap up the video. If you got any questions, go ahead and leave it in the comments. And if you know of another ETF besides SPY, QQQ, VTI, SPMO that kind of is a well diversified and has a pretty good performance that beats the S&P 500, let me know. So that's it for this video. We'll wrap it up and we'll see you next time.